Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Hong Kong and China Gas Company Limited annual report. The Hong Kong and China Gas Company Limited offers a diverse range of businesses and services across various sectors. At its core, the company provides gas supply chain management, including piped city gas projects and renewable energy solutions. It also distributes water supply and is involved in urban waste utilization projects. In addition to these primary services, the company offers a variety of related products and solutions. These include piping installation and design services for properties and retrofit projects, as well as kitchen design and appliances. The company also provides automatic meter reading systems and network connectivity services. Furthermore, the Hong Kong and China Gas Company Limited offers engineering, procurement, and construction (EPC) services, including consultancy and engineering contractor services for public and private projects. It designs and manufactures gas meters and metering systems, and is involved in water supply and wastewater treatment activities. The company's services also extend to green energy businesses, property development and investment activities, and manufacturing of polyethylene piping and fittings. Additionally, it provides software development, solution implementation, and systems integration activities. With a rich history dating back to 1862, the Hong Kong and China Gas Company Limited has established itself as a leading provider of gas and water services in Hong Kong and mainland China. The Hong Kong and China Gas Company Limited market capitalization of $137 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that the Hong Kong and China Gas Company Limited holds a significant advantage in their industry. The Hong Kong and China Gas Company Limited trades at a higher price-to-earnings ratio of 24 times and a higher price-to-book ratio of 2.38 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 57% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.77%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a review of the key performance indicators presented. On the growth side, several factors contributed to an increase in revenue. The green energy segment saw strong growth, with renewable energy businesses experiencing a significant increase of $217.6 million from 2024 to 2025. Additionally, gas sales volume remained stable in Hong Kong's utility business, and revenue recognized at a point in time increased by 10.9% for the gas, water, and waste treatment segment. Furthermore, residential gas consumption increased by 2.4%, leading to an acquisition of over 19,000 new customers in Hong Kong. The Gas Plus business also saw significant growth, with energy sales volume reaching 2.87 billion kWh. Utility businesses, including water and environmental services, experienced a water sales volume increase of 0.6% and solid waste treatment volume increase of 7%. New value-added businesses, such as direct pipe drinking water and community water stations, also contributed to revenue growth. On the decline side, several factors led to a decrease in revenue. The renewable energy business saw a decline of $217.6 million from 2024 to 2025. Revenue recognized over time decreased by 90.1% for the gas, water, and waste treatment segment. Periodic adjustments in the renewable energy industry on the Chinese mainland also contributed to the decline. Fluctuations in electricity prices and the introduction of market-oriented trading policies further impacted revenue. The adjustment on standard gas tariff for customers in Hong Kong led to a decline, as did the continued downturn in the mainland property market. A decrease in new household gas connections also contributed to the decline in revenue. Overall, these factors highlight the importance of monitoring key performance indicators and adapting to changes in the market to ensure sustained revenue growth. The financial health of a company can be gauged by its ability to generate positive operating cash flow. This metric indicates that the company is capable of producing sufficient funds from its core operations to meet its financial obligations and invest in growth initiatives. In this case, the extracted summary confirms that the company is indeed generating positive operating cash flow, as indicated on page 33. The company's debt level and interest expenses have undergone significant changes in recent periods. On the interest expense front, there has been a notable decrease of 12.7% and 13%, indicating a reduction in borrowing costs. However, this is somewhat offset by an increase in current liabilities, specifically borrowings, which rose by 25%. This increase in borrowings is substantial, but it's worth noting that non-current liabilities saw a minor decrease of 3%. The company's debt level has also experienced changes, with the net current liabilities position increasing to approximately HK $14.2 billion and borrowings repayable within 1 year reaching around HK $16.8 billion. Overall, the total debt level increased from HK $57,422 million to HK $59,701 million, a relatively modest increase of 4%. The performance of various segments and regions in the recent period has been mixed. On a positive note, renewable energy sources such as green methanol, hydrogen energy, and sustainable aviation fuel have shown significant growth. Additionally, smart living businesses have also performed well. In terms of consumption, residential gas usage has seen a 2.4% year-on-year increase. On the other hand, commercial and industrial gas consumption has declined by 2.6%, indicating a slowdown in these sectors. Hong Kong's retail and food and beverage businesses have also struggled, reflecting broader economic challenges faced by the region. Despite this, Hong Kong's economy as a whole has shown resilience, with some segments performing better than others. The company has a history of paying out dividends to its shareholders. This is evident from the information provided on pages 3-18, where it explicitly states that the company has paid dividends. Furthermore, the interim and final dividend amounts are also specified, indicating a clear commitment to rewarding investors through dividend payments. That concludes the financial summary for the Hong Kong and China Gas Company Limited. Feel free to comment below, and I will be happy to answer them when possible.